right, Justin, time to talk about everybody's favorite. It's real estate time, baby.
Here we go.
Yeah, so last week, obviously, we wrapped up private equity, went into a little bit of a deep dive there. We teased out the fact we were going to come over to real estate today. So I know there's going to be, four or 5,000 people listening this week. But in all seriousness, real estate's a fantastic asset class, huge wealth builder for a lot of people. And generally, I think just an interest of everybody. So this will be a lot of fun. We'll jump on in. We're going to talk about different ways to invest in real estate, what we can actually expect, where does the power of real estate actually come into play? And then we'll kind of get to the end. We'll talk a little bit about the different ways that you can actually access real estate. And we might even do a follow-up episode of how to go about doing due diligence on those investments. But, as we get kicked off here, Justin, maybe just start to lay the land for us a little bit. Just would love to know, is the only way to invest in real estate to go buy a property and manage it myself? Can I do it in the public markets? Just give me the lay of the land.
Short answer is no. Actually, there are some great vehicles, and there's a number of different vehicles in which you can invest either directly or indirectly within real estate. But a lot of real estate is actually held in vehicles that are called real estate investment trusts, REITs for short. And those are generally, they're not exclusively, but generally publicly traded. So you can go, they have a ticker or a QSIP if you want to get technical, just like a regular old stock does. And you can go to the market and buy a REIT. That REIT can represent a number of different underlying holdings. It could be specific to a specific area within real estate, whether it be industrial, commercial, office, residential, multifamily, et cetera, et cetera. The list kind of goes on. So that's one way, right? That's the public market, common public market way. It's not the only public market way. REITs aren't the only things. There's some other nuances, but REITs by and large are the main way to get access in the public markets. They're a big way you can get access in the private markets as well. But I think the most common assumption or a familiarity, if you will, within investing in real estate in the private markets is probably buying a piece of property yourself. There are also funds, which, little teaser here, it's probably a little bit better to go the fund route because we talk a lot here on the podcast about diversification. And one of the hurdles from an analytical standpoint, if you will, or if you're thinking about real estate really from scratch, is it's hard to get diversification, especially within the private market side of things, and we'll talk a little bit about that, I'm sure, in the coming weeks. But you can go buy a property yourself. You could bring together a handful of investors, and the 4 or 5 of you go and buy a property together, or you can go to a fund. I mean, those are the most common ways, I think, in which you can get access to real estate, both in the public markets and the private markets.
I think that's a great lay of the land. And one thing that I hear a lot when I'm talking with clients or just out there, right, is passive income. I want the passive income. It's a passive investment. Real estate's a passive investment. And I would love for us to spend at least a few minutes just talking about that, because I think, a lot of people think real estate's the only passive way to go about generating wealth. And when you start to actually think about it, like you just laid out, if most people are actually going out and buying a property, managing that property, trying to collect rents, hound down, I don't know how passive that is,
not passive.
Versus going and buying a position in equity or an ETF on the public markets, that's a heck of a lot more passive. Yeah. If you ask me, hit the button. Now you own equities in a bunch of different companies. So, I think there's some nuance there, but why do people think that real estate is such passive income? Like, is it just because, you kind of set it and forget it? Once you get a renter in place, in theory, you just start to see this mailbox money, these checks coming in?
I think so. I think it has a lot to do with that. I mean, most real estate is an income-oriented asset, meaning let's just say it's a multifamily apartment building, and those tenants pay rent, or it's a retail building or strip mall or something like that, the tenants, those businesses are paying rent. Now you have expenses to deduct from that rent, and hopefully those expenses are not more than the rent you're collecting. But it just kind of by the nature of real estate and how it operates as an asset, I think income is very much directly associated with that. However, you alluded to, and we're saying a lot of this with tongue in cheek, because it's a very, very common misconception. And it doesn't mean real estate's a bad asset, and really want to make sure we hit on that. It's a very, very good asset to hold in a well-diversified portfolio. It's not the only asset you should hold. But there's a lot of misconceptions around real estate, and this passive income piece of it is one of them. Because if you are doing it directly, and maybe you have 5, 10 properties even, and like starting to make an actual business out of it, there's a lot, just kind of by the nature of what I'm saying, it's a business. There's a lot of work that's involved with it. I've never met anyone who actually says they like being a landlord either. And typically people get into a single property or 2 properties and really kind of reconsider things. But I would say real estate, first, kind of to directly answer your question, real estate is a form of passive income, although again, if you're doing it in the wrong way, it's actually a lot more work than I think people generally set out with the idea of. But investing overall, especially investing for the long term, for your goals, et cetera, that is all passive. It's all passive income. And we're not talking about active management versus passive management in this sense. I mean, there's some relations to that, but really in the sense, and Brandon, you really alluded to it, you go buy it. Let's just say you go buy a stock. In the very simplest example here, you go buy a stock on the, go into your brokerage account, type in Apple as an example, or let's say JP Morgan's maybe a better example. JP Morgan pays you a dividend, and guess what? You don't have to do anything for that. You had to go into your brokerage account and hit buy. Transaction happens, and you get money into your account every time it pays a dividend, right? That is pure passive income, right? So there are multiple avenues, multiple channels within a really well-built investment portfolio that passive income or passive growth, let's even redefine this as passive growth, right, comes from, because that's the better way to think about it.
Yeah, and we're going to get into that in a second here, what types of returns should we expect? But I think you've alluded to it several times, so probably time to start to put some clarification around this. But what are the different areas of real estate, right? We've got residential, we've got multifamily, commercial, industrial. Maybe just give us like the 1-2 second explanation. Like, what are these different areas? Who are the competitors? Because this is still a pros game, right? If you're, especially on the private side, if you want to come and compete here and really get the return that you deserve, I mean, there's a lot of diligence that goes into this. Oh, yeah. I mean, we talk to a lot of very professional real estate investors that have made a lot of wealth investing in real estate. And it is not simply I'm getting $1,000 a month in rent, my mortgage is $900. I'm in the black here, right? Like it's a pretty sophisticated way to go about it. So maybe just define some of these more common types of real estate, and then also maybe the landscape of who you're competing against when you go to invest here.
Sure. So, like you mentioned, I've alluded to some of these residential, and you hit on quite a few as well. Residential, I mean, the names kind of are self-explanatory, but let's really define it. Residential from an investment standpoint, it's not, generally speaking, just building one house. It's probably building a development of single family homes. Multifamily, which is generally just a little teaser. It's kind of where we like to go within private real estate specifically, but multifamily is something like an apartment building that has a number of different units in it. Ideally it's a decent size, because you kind of just get built-in diversification through multifamily that way. Industrial, think something like, I mean, industrial could be anything from industrial scientific to
Big Amazon warehouse, right?
Amazon warehouse, things of that nature. And you're playing with very large properties, generally speaking, within the industrial space. Again, there's always different flavors of this, and you can find a small little industrial warehouse somewhere. But typically speaking, in the industrial, like really competitive, good returning part of the market, there's some big players in that space. And then commercial, you have retail kind of as a subset within that, and then also office space. So we're in an office building right now that would fall under office commercial in a sense. And yeah, I mean, to your point, I'll just touch on briefly the due diligence that's required. I was talking to a friend who is in the real estate space actually yesterday, and it's getting boots on the ground. It's looking at the actual quality of the asset. If we buy this, do we have to put a significant amount of money into it to bring it up to code? What about the environmental regulations on it? This particular property actually had some issues that they were going to have to potentially put in $1.5 million to $2 million to get it back up to code, essentially. Now, the purchase price was potentially attractive enough for them to even consider that. Don't know if it's going to happen, but just kind of to give you some flavor, you got to go through all the leases that are existing in place on that property. You can't, it depends on where you are and what the tenant protections are, but you can't just come into a property that is a clean slate unless it is completely new construction. So which we'll touch on too, like phase of real estate and whatnot as well. So just a little bit of a flavor on all of those things.
I think that's really helpful. And as we can tell here, I think this is definitely going to be a multi-episode deal because we haven't even touched on how do you calculate returns, how do you do due diligence. But, I do think a good place maybe for us to spend a little time as we likely wrap up here to keep it within time is, what type of return, and I'm speaking mostly obviously on the private market side, but if I'm going to go invest in private market real estate, I want to make sure as an investor I'm getting what I deserve. And I think this is where people get tripped up quite a bit. But how should you look at that? What should you deserve if you're going to tie up your money? You're going to put the effort into doing the due diligence on a property specifically, or maybe even a fund. We haven't even hit on how to do that yet, but broadly speaking, how do you start to construct an equivalent of like, hey, I deserve 10% or 12 or whatever it might be, but how do you get to that number?
Well, certainly, and you alluded to it, it depends on the stage and the risk and all that stuff. But there are actually really well constructed sources out there to get somewhat of a ballpark or approximate expectation. I just pulled it up. So Cambridge Associates is a big research provider within the private market arena, both private equity, venture capital, real estate as well. They put together a private real estate index, and just to give some flavor of numbers here, over the last 10 years, their index has done 11.27%. Over a 20-year period of time, it's a little bit less, 7.68 or 7.88, 25 years is 8.12. So it's been a good last decade for real estate, but real estate in general is not the best performing asset class. I think that's another misconception that happens out there. The other piece of it is really important this is very much specific to a deal or a property or an asset, is real estate is very conducive to using leverage on. And that really changes your return profile, or can really change your return profile and risk profile for that matter, right? Risk and return are related. So that's a big thing to keep in mind. Real estate, a lot of returns within real estate do come from that leverage component. What I mean, let's be super clear here. What I mean by leverage is everyone here or most people listening is familiar with a mortgage. That is leverage on an asset. You are borrowing money to purchase a property, and real estate, it's very much conducive to that type of transaction, which can help returns, but can also hurt returns.
Yeah, I mean, it can be done very safely, right? And I think the equivalent, and just to put some perspective, is I think most people would think it would be well, not everybody, but most people would think it would be ridiculous to take out a loan and go invest in the stock market, right?
Right.
But that's essentially what you're doing in real estate. And, you've got the backing of the property if things go poorly, et cetera. But things do occasionally go poorly. And so you want to make sure that you're right sizing your debt when you're going to purchase a property. But in reality, that is what's going to generate a big part of your return within real estate. So, it's definitely on the evaluation table. There's no doubt about that, right? So if those types of returns are what, for instance, that benchmark, those are average returns. So, it doesn't mean, you go buy a property, you're going to get that return every time, right? You want to make sure to build out a portfolio. You want to make sure that you're hopefully getting at least that, or looking at even the public market equivalents. Like we talked about, you can invest in the public markets in real estate. So let me look at what that return has been. And if it's been 8% over the last 10 years and I'm tying up my money, I want what's called an illiquidity premium. I deserve, right, to get a little bit more because I'm tying up my money. So maybe I'm looking for 10%, for instance. But I think you have to go through that exercise, right? When you're putting your models together to figure out, hey, is this a property worth investing in?
Yeah.
So it's not simply just going and covering some of the expenses, covering the mortgage, et cetera, right? Well, Justin, that was a lot of fun. We got a lot of follow-up still to this episode. I think we're going to have to get into some due diligence. How are we going to go about this process? If we're looking at a fund, if we're looking at a property, we've talked about, maybe the return that we actually have to achieve. But definitely warrants a follow-up here. But as we close out, just want to remind everybody, you can shoot me a text. I'm sure there'll be lots of questions coming out of this. We got more real estate coming. So shoot me a text at 602-704-5574. We'll get to all those questions and definitely look forward to that follow-up. But until next time, own your wealth, make an impact, and always be a pro.
The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.